So good evening, everyone. Good evening. First thing, can I just do a sound check? Could you let me know if you can hear me loud and clear? I just want to get that sorted. Please type into the questions box if you can hear me. So at least, there we go. Good evening. Fantastic. Okay, good. Excellent. So, all right, great. Now, welcome to this evening's presentation. Thank you very much. Welcome to this evening's presentation. And my name is Adam from Trade with Precision, and welcome to this. It's a Forex Masterclass. We're going to be talking about 5 advanced techniques for successfully trading the FX market, and it's brought to you by myself, Adam from Trade with Precision, and ATFX. I love these things just because I get a chance to spend time with people. I trade from home. I'm a fund trader. I'm also a trend-based trader and a swing trader, which I'll explain to you as we go. But you lucky people, the first folks I've had to chat to today, so that's why I'm going to be so chatty. So now that we know the audio is working fine, what I do need to do is to give you a moment to read these 2 disclaimers, and then we can kick off. While you're reading that, I will tell you a bit about myself. So I'm based in London in the United Kingdom. If you can tell from my accent, I'm South African. I grew up in Cape Town and worked in Johannesburg, and I've been in the UK for about 10, 11 years now. And I am a swing trader. All right, in my previous life, I was a visual effects animator, so some technical background there, and now I am a technical analyst in terms of trading. So I've transitioned, changed careers, and I've been doing this for about 10 years. And I am a swing trader, which mainly means that I enter on the daily and 4-hourly timeframes. I can trade on the lower timeframes, but in terms of my lifestyle, I really dedicate between about 30 minutes to an hour to trading each day. And it just doesn't require me to sit in front of the charts all day long. I would love for this to be interactive. So if you have any questions, please ask them as we go through, and I will endeavor to answer them as you type them in. Okay, now the only other catch we have is that we have 60 minutes and I need to convey quite a bit of information through to you. You may want to take notes. I am recording the session. It will be up to ATFX if they want to forward that recording to you, but I'm recording it, but you may want to take notes as we go through. So on the agenda for this evening, we're going to be talking about back to basics. It's a summary on technical analysis, price action, and trend analysis, as you may or may not know. All right, so this session will be useful to both beginner traders and intermediate and potentially advanced or more experienced traders, or individuals who've been doing this for a couple of years. This is really about achieving consistency, but for the beginner traders, it's about trying to help you avoid the things that are going to waste your time. And so you may or may not know this, but trading is really about doing the basic things very well. It's not about complexity, it's about simplicity. That's part of the reason that most people struggle and misfire when they're trying to learn how to trade. They convince themselves that it must be more complex than it is, and it isn't, but it is about doing the basic things properly. And so they skip the basic things and then subsequently don't go any further. We're also going to be talking about advanced techniques, especially suited for Forex. We'll do some live chart action where I can apply these. I'll show you some of the markets I'm concentrating on. And I have, as I said, about, let's call it 55 minutes where I want to get through that. So what I want to do here is I'll come back to these slides as I get onto the topics. But what I want to do is finish up the slides at the end so that I can relax. I can go to the platform and I can talk you through the various points. So if you're not familiar with ATFX, all right, obviously they're award-winning. They are regulated by the FCA. There is the license number. They're efficient, secure, easy-to-use payment portal. They're very committed to providing competitive pricing for their clients. Execution and pricing is key just to make it a more efficient business for everyone. Global investors obviously using the MT4 platform. What's great about the MT4 platform to some degree is the openness, access to tools and indicators that are out there that can assist traders who are new to it as well. And of course, there's bespoke customer service and trade support for clients 24 hours a day, 5 days a week. All right. Now, these will be the contact details that I will come back to at the end. All right, so that we can finish on that. That'll be right at the end. Let's go back to the slides where I'm going to be talking to you about the various topics. Here we go. So key concepts that must be mastered. Okay, so just to give you a little bit of bearing on this, I paid a lot of money to do a lot of education, and I was thrown various strategies, tons of strategies, lots of kind of technical jargon, and all of that's fine and well. But really what it was that in amongst all the technical information that I was given, although it is technically correct, I wasn't really taught how to apply it. All right, so it isn't just about the fact that we need to know what an uptrend is or a downtrend is. It's really about how we go to a live chart and apply that so that we're doing things the way experienced traders do it. Okay, so what we need to do, all right, so there's a couple of things that we need to do, and I've tried to do it in order of importance. We need to appreciate that trends and price action are very important. I'm going to demonstrate this by going to a chart and actually showing you this. All right, so I want you to, ideally at the top of the hour of this webinar would be to give all of you a clearer sense of what it is that you need to know to get you where you want to go. All right, as opposed to kind of a bit of voodoo and smoke and mirrors that we hear about in the media. Is the market moving because of what Trump says? Is it because of Brexit? What chart should I be looking at? Is there actually a trade set up here? I really would like you to be closer to that. I'm just reading your comments as we go. Thank you very much. Yep, absolutely. So when we talk about, so I'm a trend trader. Now, as I said, I spent a lot of time on education and doing a lot of different programs, and I was taught all these different strategies, how to trade a range, how to trade trend reversals, all these various things. And ultimately, I then settled on following Nick McDonald, who founded Trade with Precision. I followed his stuff, and it was the best, and still to date is the best stuff that I've ever seen. And really, the only reason is, first of all, he's a bit of a natural. But the other reason it's successful is because he has let a lot of the noise go. And so what's left over is the very high probability stuff. Okay, so let me explain what I mean by that. If I switch over, and just bear with me, I'm going to have to, I might not even have to do that. I was going to say switch over to the platform. And let me just change us across to that so you can see what, so now you should be able to see obviously what is on my on my screen. We're looking at a chart, and predominantly what we are doing and what Nick would do is just focus on trending markets. Okay, so starting by looking at the daily, we'd be looking at markets and always trading in the direction of the trend. So this one is clearly now in a downtrend. All right, the markets are looking particularly bearish today as well, and previously it was in an uptrend. Okay, so the point is very much so that it matters immensely, almost more than what we're trading. In terms of, it matters almost more than whether we're trading a currency or a commodity or an index or an equity. The thing that actually matters the most is what are the trading conditions. Is it, because a market, any market on any time frame can only exist in one of two states, right? It's either not trending or it's trending. And if it's trending, it's either trending up, in which case we should be looking to buy at the right time. And if it's trending down, we should be looking to sell at the right time. And that's crucial. Almost more than anything else, we should be picking a trending market because, and I know this sounds so simple, it is almost like stating the obvious, but people don't do it. Or beginner traders don't do it, and I was there. We need to, first of all, know what a trend actually looks like, so that if we come across a chart, we can go, okay, this market is trending versus a market that isn't trending. This one is now starting to trend heavily. I already know from this that if I go down to the 4 hourly, there's a good trend there as well. So let me just clean this up a little bit, bring it across there and switch it down to the 4 hourly, and even go down to 30 minute. I can see that this has been trending beautifully. So what you see in front of you is a beautiful trend. All right, there's a clear momentum to the market. The odds of it going down are much greater than it going in any other direction. So the probabilities right off the bat are good for me. What I need then is an optimal entry, and I have to take profit. All right, so the chances are that it's going to keep going lower, but just in case it doesn't, I've got to put a stop loss in. Just in case when I get in Sod's Law, Murphy's Law, it changes direction, I have to put a stop loss in. All right, so how will I know if it's changing trend? Well, okay, when we look at it, we have lower highs. Okay, this is what we refer to as trend structures. We have got lower highs. The turning points at the top are swing highs, and the turning points at the bottom are swing lows. So we have lower highs and lower lows. That's how we define a downtrend. And if we're always looking at the last 20 to 40 candles, we can get a sense of what is the current price action on this chart doing. This chart is currently in a downtrend. So the question you've asked me is, which tools do I use to determine trending marker? Okay, so I'm not specifically sure what you mean, but I'm looking at price action here. So I'm looking at the candlesticks, not worried about the moving averages. Purely candlesticks is telling me that this is a downtrend. Boom. Okay, so this is a downtrend. I should be looking to sell. Now, what is interesting about this is that if I look at the 10 and 20 moving averages together, so imagine the blue and the black. So I've got a 50, 20 and 10 moving average here, and I'm using simple moving averages, nothing fancy. But I can see that when it's trending really well, it interacts with the 10 and 20 moving averages beautifully. If I go to the daily here, you'll see on the way up, it's also interacting very well with the 10 and 20 moving averages. So a healthy trend, a really nice trend, well-behaved trend, will interact with the 10 and 20 moving averages very well, almost like a train station. The price action is the train, leaves the train station, comes back to the 10 and 20 moving averages, that's where the train station is, and then it leaves again. If I arrive on the chart and it has already left the station, then I've kind of missed that opportunity. I have to wait for it to come back. All of my entries into a nice healthy trend should always be from the moving averages. If I've missed it, then tough. I have to wait for the next one. But the good news being is at least that stops me from getting in too late. It also tells me that if I just wait till it comes back to the moving averages, that's the right place to get in. So actually ahead of time, I can tell when I should get in. So that sort of gives me a sense of that's how healthy, nice, well-behaved trends behave. And currently, if I look, I can see that it's starting to do that. It's a bit overextended at the moment. It's going from red bearish candles to a bit of a bullish candle, potentially getting ready to retrace to come back up to the moving averages. I do not want to counter trend trade this. Why? Well, because sometimes it doesn't come back up. Sometimes it just goes sideways and then carries on down. Counter trend trading is very high risk, very low probability and not much profitable. It's not very profitable. Trading with the trend, if all I have to do is wait for those opportunities when it comes back to the moving averages and goes, is the highest, most profitable way to trade and the lowest risk, relatively speaking. Why? Because the momentum is clearly in one direction, up or down. And going from the moving averages, the probabilities, we're always going to have losing trades. The difference is, if I'm trying to get into a nice healthy trend, the losing trades happen far fewer, and at least I'm going in the right direction. With every other type of trading, range trading or counter trend trading, I'm going against the flow. And by the way, what causes the flow is the big fish. There's none of this voodoo about we're trading against the brokers and the market is going against us. When we're trading a trend, we are trading with the big money. Okay, we trade with the big money, and that is in line with the big fish. So we're actually trading the same way as the big money, and that's what we want to do. So this is key. If I go back to, okay, give me a second here, please. Okay, so sorry, just saying you didn't know this would be in English tonight. All right. Just do this quickly. Cool. All right. So that should, the sound should improve if that's the case. So the next question is, does your software allow you to set up buy points when the price pulls back to the moving average? So usually, currently, there's no software. This is done manually. So we're talking now about manual discretionary trading, the way that the city traders do it. Okay, so usually we will wait for price to come back into the moving averages and then look for entry opportunities into that trend. Okay, so what I want to do here is let's just go back to the slides quickly. Now, so part one of what I really wanted to talk to you about here is, first of all, about identifying a trend and price action analysis. So price action analysis is really looking at those lower highs and lower lows, looking at price action, the candlesticks, and seeing how they're clearly moving in a given direction, up or down. And this helps us identify trends. Okay, so that I'm going to get onto this in a moment, horizontal support and resistance levels. But first I want to wrap up the price action comment, the first point. So I'm just going to go back to the charts here and talk about a little bit about this. So there'll be times when the market, any market, is clearly not trending. So as I said, it doesn't really matter what the instrument is per se. It matters very much what are the conditions of the market. Okay, we don't trade a market because of the logo or the brand. We trade it because it's trending. So let's go and have a look at a market that may or may not be moving anywhere. Let's have a look. Let's look at a various one. So this one has gone from an uptrend into a downtrend. It's now starting to trend actually really well. So now I'm potentially in a position to look for an entry to sell the market in this area. Okay, let me just go through and change the color of that so it doesn't look so aggressive. Just anything, something nice and light. Okay, I'm looking for a potential sell area when price retraces back into the moving averages. That would be, for example, what we refer to as a trend flow entry. Okay, so that's a nice retracement back into that area and a nice sell opportunity here. I see the 50, 20, and 10 have now switched, and I can see the price action is now trending lower. So this could potentially sit on my, I've done my trading for today, so I can come back in and look at this potentially tomorrow. So that was the point, was to show you this has got a nice trend. I'm not too concerned with that. I'm going to be more concerned with a market that has no clear trend. So let's have a look at a few other markets. What's going on with Euro Swissy? Okay, Euro Swissy is trending very nicely on this time frame. That's good. Let's have a look at Euro GBP. Okay, Euro GBP is not trending as well. It's generally flowing to the upside, but it's clearly encountering some resistance. Let's have a look at Euro Yen. Euro Yen is trending beautifully, and this, in fact, is setting up for a potential sell opportunity right now. It's coming back into the moving averages. It's got that behavior. Looks nice little red candle at the top of the hour. So we'll see where we are close at 8 o'clock. Would be a potential sell opportunity. That might be quite interesting. Let's go up to the 4-hourly and let's have a look. So these conditions, interestingly enough, these conditions are not trending conditions. Okay, you can see here, this is a nice trend heading down here. Okay, nice little trend coming this way. But in this particular area, the market is going largely sideways. So I want to avoid markets where there is no clear trend. That's a concern of mine. I want to make sure that I am not getting stuck in a market where there is no clear trend. Okay, so let's have a look at a few other markets quickly. What does Pound Aussie look like? Okay, it's not as clear a trend as before. Pound CAD, let's just go through a few of these. You can see that actually some good trends that we've had lately, and currencies can go through large patches where they don't trend as much. This is a beautiful trend. Look at that. Picture perfect trend. Absolutely lovely. That's really nice. These are the kind of markets, this is what we refer to as optimal price action. This is a beautiful trend. Okay, that is, compared to all the other kinds of conditions we can trade, these are safer conditions. Okay, trading itself can range from lower risk to high risk, but this is on the lower risk end of that scale. Okay, this one has been moving. It's interesting because actually, if you attended this webinar every month or every time we did it, the market conditions are not always going to be the same. As it happens tonight, you are seeing a lot of trends, like a lot of trends, and we don't normally have this. Okay, normally there's 1 or 2 charts. Now it looks like every single thing I'm looking at is trending. Okay, let's go up. So I really want to show you a market that isn't trending very well. This one's not great. Okay, it's not a clear trend. I want something that's clearly heading to one side or another. What's going on with Kiwi? Swissy, that's trending because Kiwi, basically the Aussie, Kiwi, and GBP charts are trending like crazy. There we go. Okay, now that's trending to the upside. This is amazing. Okay, this one is not trending as well. So if I compare this to previous charts, not as strong. What's going on with CAD Swissy? CAD Swissy overall, still generally stuck within this range. Definitely not trending as well as some of the other charts that we've seen. So it's important to me that I pick a chart that has a very strong trend. Okay, that's something I want to impress upon you. I'm looking at your comments. How far should I place my stop loss after entry? The trend is that once the market has kicked me out through stop loss, it should come back to whipsaw. What is the best time frame to trade? Okay, those are both very good questions. So very important. A trend, if we go to one of these things that's trending very nicely, a trend here, a downtrend, is made up of lower highs and lower lows. Generally speaking, when the market produces a higher low, higher high, it has gone into an uptrend. And if it breaks above a previous high. So that's how I know the market has definitely stopped. That because trends change, trends start, then they finish, then they die. A trend will end. The market will then go sideways or it'll change direction. The point is there is a line in the sand where that trend is finished. And usually it's when either we go from a downtrend of lower highs and lower lows to higher lows and higher highs, or when we break a previous lower high. So in this case, the fact that it's producing lower highs is a downtrend. Once it breaks a lower high, then that trend is definitely done. So for example, this downtrend is still intact. Okay, but if we break, you can see here there's a previous lower high. Once we break that, then this downtrend is potentially finished. So basically there will be a line in the sand. I'm just trying to find a nice chart where I can demonstrate. Like this is a great example of a chart there's no money to be made here. In fact, this is probably just going to lose money. Any trades we take, there's no clear direction here. This market is ping-ponging around. There's a battle between the bulls and the bears. It can change its mind at any point. Very high risk, very high probability of losing money. Okay, this one has started to climb. So where do I put my stop loss? Well, the most sensible place to put my stop loss, if I'm going to buy in this situation, is underneath this swing low. Why? Because if the market goes down now, then that trend is finished. So usually it's the higher lows and higher highs in an uptrend. We want to think about, we usually at Trade with Precision, we put our stop losses below the most recent swing low, because that, once it crosses that line, then this uptrend is done. Okay, so I need to make sure, because we've got so many points to get through, I've got to start to progress onto the next ones. And in fact, I may skip the second slide already. So the other question was, what is the best time frame to trade trends? Well, if I could go back in time to me, when I was starting to trade, I would say, Adam, focus on the daily and the 4-hourly in the beginning for the first 6 months. Why? Because there's so much to focus on and learn and absorb. It's the same as, imagine that the very, very first time I got into a car. Okay, in South Africa, you can learn to drive when you're 17, I think. You get your license when you're 18 to drive a car. But imagine on my very first day of learning how to drive a car, I drive onto the highway during peak traffic. It would just be dangerous and just such a bad idea. There would be too much happening. I'm still trying to learn where the indicator is to put my seatbelt in to check my blind spot. It's just too much information. I'm not ready for it. So for traders, the goal, by the way, is not to trade on the lower timeframes. That's not a goal. Some traders like to trade on the lower timeframes. That's the 15-minute, 30-minute, the 1 hour. Other traders like to trade on the 4-hour and the daily. All right, the goal isn't one or the other. The goal is really to find where you are the most comfortable for your lifestyle. For me, currently, I like trading the daily and the 4-hourly. It's not as volatile. The trend moves a lot slower, and I actually make more money. All right, on the lower time frames, the 5-minute chart can change trend 10 times throughout the day. It's massively impacted by news announcements. There are some opportunities there, but I can also sit in front of the charts the whole day. Whereas on the daily, if I'm just looking at the daily or the 4-hourly, I only have to check the charts once or twice a day, and I can make, I don't know, I could make 4 to 8% in a month. So there are pros and cons for both. But for myself, if I could go back in time, I'd say start by doing mastering trading on the daily and 4-hourly for the first 6 months. And then if you want to go to the lower time frames, because by now your ability to identify a trend, read the daily, calculate your risk, place your orders, you've got better at that. You don't have to try to think about 20 things at once. You can now just think about 3 or 4 things at once. So to go back to the slide deck, so this is something that's very important, is understanding that we need to understand trends and price action, really meaning that we want to focus on markets that have a clear, well-behaved trend. Okay, those are, relatively speaking, they are safer to trade because, and we go in the same direction, not counter trend trading. Horizontal support and resistance levels. So we're only on 0.2 and we're almost halfway through this evening's presentation. So I understand that there's a lot of information to get through here, but that was a very important one to get through. horizontal support and resistance levels are the second most important factor for every trader to understand. Okay, it's because when we're basically identifying or we're looking at a chart, we need to really understand where are the most important levels, because the market is very much about price. Okay, so I'm going to go back to the chart here and demonstrate this. Okay, the markets are very much about price. When we look at a blank chart, the only way that we can really organize it into some sort of sensible behavior is by identifying the key levels that we need to be paying attention to. Once we start to organize that information, once we start to organize this information, it starts to make more sense to us. The way the market behaves is it will move from one level to another. Okay, that's where we make our profit. We make our profit in the sections between the key horizontal levels. When the market breaks through one level, it generally goes down to the next level. So that tells me how much potential profit is in this move if I can get a good entry here. Okay, now the thing is that these levels are here forever. They will stay. A horizontal level will stay there forever. It's a price level, and it's very psychologically significant. Even to people who aren't looking at a chart, they're thinking about price. So if all the different people that are getting in and out of the market, there's hedge funds, there's tourists exchanging money, there's banks ordering supplies from other countries. Think about all the American countries now trying to, ironically, ordering electronic parts from Japan and China. So there's exchange rates, money changing hands, businesses being done, people ordering stuff off Amazon. There's an underlying market. It's not moved predominantly by traders. We need to understand that. Banks have to hold foreign exchange, cash. And so these price levels are significant to all those participants. If we then go down to the lower time frames, so if I go down, this is a monthly, I need to know where are the very significant levels on the monthly, weekly, and daily levels. Those are actually really important. When I go down to the lower time frames, there will be price levels that will show up on those time frames that I didn't see. Okay, so if I go ahead and just move this back here, there's now key levels that are visible on the weekly time frame that I didn't see before on the monthly. So sometimes what I like to do is color code them. So in the same way that I have a 50, 20, and 10 for the medium term and shorter term price averages, I might change the color here for the monthly, weekly, and daily. Those are really the most important price levels that we need to know are there. Okay, that tells me, so now I can see that as price heads down, there's a level here that I need to be aware of. That tells me that I need to be cautious of what's going on between these levels. Okay, so horizontal support and resistance levels are the best ways to identify where price is likely to go to next. And the beauty of this is they can also offer some potential entry opportunities. They can offer potential stop loss if I put my stop loss above those levels as well. And also where I need to be taking profit. I need to know where to take profits. And sometimes that helps me look at a trade and go, all right, this could be a 3-to-1 trade or a 4-to-1 trade because the market has the potential to move that far. So those horizontal levels take practice, and it helps if we start by looking at the monthly, weekly, and daily. Now, so the question is, where do we draw it? Well, usually we need a minimum of 2 touches to identify a level. So if we look here, there's a potential level here. And I'm particularly interested in areas where we touch it from above and from below, all right, because that's particularly significant to the market. The market has come down. And also, I'm not concerned so much about the body of the candle or the wick, because they will often both be the same. I really want to draw a line that connects as much of both as possible. Okay, it is possible sometimes to get 2 levels close to each other. So if you look, there could be 2 here, but this is definitely a key one. That's very important. And I need to do that. In order to also keep my, not suffer from kind of having too many lines on my chart, all right, I can just focus on the ones around the price action. Okay, so let's just get rid of these 2 rectangles. And I can focus on levels around my price action. So I can get rid of that one and really just keep an eye on the key ones. So I don't need this one for now. Okay, just get rid of that level and then focus more around price action. That way I keep it nice and clean and simple. Okay, if I go down to the daily, there's going to be some more levels here. Okay, let's just go do this quickly. Let that just update. Okay, it's going to eventually correct. And so here I want to be aware of other potential levels. And this is a mess. Look at this chart. It's a mess, which is why I would probably not trade this. Currently, this sums up the US and the Euro's psychology at the moment. Generally, it's heading lower. If you look at the 50, 20, and 10, the moving averages, they're heading lower. So the average of price is heading lower, but the price action, look at these, look at the swings, the candlesticks, it's incredibly volatile. So this is incredibly volatile. It just is very choppy, very dangerous. If somebody asked me to analyze the chart, I can tell you here that the euro is generally weakening against the US dollar, but also I wouldn't trade it. So I can say, oh, well, the longer term movement is to the downside, but this is incredibly choppy and violent. Okay, it's volatile. So these are not the kind of conditions that I want to get into, because it's going to be stressful. I'm probably going to lose money, and the market is not well behaved. So, and the question here, these are great questions, by the way, ladies and gentlemen. Is there a maximum number of support lines that should be used per time frame? No, there isn't. What we do want to do is focus on, start on the higher time frames, the monthly, the weekly, and the daily, because, and they should be obvious. You don't want, if you find you've got too many, then it's going to drive you nuts. Okay, it's just going to go nuts. It shouldn't be doing that. So some of the charts, yeah, it's going to be doing that. All right. How many assets are on my watch list? How many do I scan a day? Okay, so if we look at, say, euro dollar, GBP dollar, Aussie dollar, US dollar, Kiwi dollar, dollar yen, dollar CAD, dollar Swissy, and then variations of that. So euro Aussie, euro yen, euro Kiwi, pound yen, pound Aussie, and so on. We get 27 currencies, give or take. So it's about 27 currencies. There's about 5 or 6 indices, and maybe commodities, 4 or 5 commodities, gold, oil, silver, and so on. To go through those by looking at the daily chart is very easy. It won't take me more than 5 minutes to go through them. If I look at the daily, this is a great little tip I'll give you a clue on. If the daily isn't trending, there's nothing to be made on the lower time frames. So this is not trending. If you look at the last 20 candles here, this isn't trending. There's no money to be made here. That's just if I trade that, I'm gambling. If I go to a chart where the last 10 or 20 candles are trending beautifully, then there's a potential trading opportunity here. Looking at the last 20, that's trending. The daily is trending. It's beautiful. Okay. Let's have a look at these. This one is trending. There's money making opportunities there. Okay, let's go down. Dollar Sing, it's trending. It's not as nice as some of the others. CAD Swissy, this one's not trending as nicely as the others. I don't like that. I prefer the other charts. Let's have a look at the DAX. The DAX is not trending right now. It is in, if you look at this, it's in a weekly uptrend, but the daily is a bit of a mess. Okay, the daily is actually pulled back and it's produced a lower high. There's a lower high, but it hasn't produced a lower low. Right now, this is in between trends. It doesn't know what to do. So there's no trend. I said to you before, a market can either be trending or not trending. It's not trending. Let's look at this market. Same thing again. Looks like it's about to break through that support level, then it's going to head lower. Looking at oil, US oil. US oil is now starting to head lower. It's in a downtrend, looking more bearish. What does silver look like? Okay, sorry, silver. There we go. Silver's heading lower, looks nice and bearish. It's not the smoothest trend I've ever seen. It's not a beautiful trend. So I want to select on my watch list the ones with the best trends, first of all. Okay, those are the ones with the safest conditions, relatively speaking. Look at this one. There's no clear trend here. And that's it. So that's where my loyalty lies. Ladies and gents, we're here to make money. There's nothing wrong with that. We're here to make money. Once we develop the skill to do it, we earn the profits that we make. We deserve it because it's a hard skill to develop. It's learnable, but it's like learning a language or a musical instrument or a professional sport. There is some effort involved, but once you get to a point, you start being more successful than not. All right, and we deserve the profits we make from this because most people will give up before they master how to play a musical instrument or learn a new language. That's all. So let me go back to the slides because I've got to keep an eye on the time frame, ladies and gentlemen, so please bear with me. So here's another great question. I've seen some support and resistance lines drawn at an angle. So basically trend lines. That's a great point here. So here we've got this line. It's very thin. I'm just going to edit that so it doesn't look quite so thin. Let's go up this way. So we draw lines like this. Now trade with precision, we don't do this. Let me explain why. What we want to do is take away things that aren't 80, 70, 80, 90% reliable. All right, trend lines, yes, sometimes we see price react to them, but on average, they're not reliable enough. If we take them away, believe it or not, our trading results don't drop, they don't diminish. So what we're talking about tonight are the things that traders must use, and then the rest are optional. So trend lines are great, and also once price moves on from it, it may never come back to that trend line, but horizontal levels will be relevant forever into the future indefinitely. So therefore, we have found that if we get rid of these trend lines, it doesn't deteriorate, it doesn't impact our trading negatively. So we just don't find them powerful enough to use. It's interesting because sometimes price is exactly within a channel, but we find it just not reliable enough. Okay. By the way, we do like Fibonacci, we do like pivot levels, lots of things we like, and everyone who's listening tonight is free to go away and decide if they on their own feel that trend lines add value or not. So now there's a trader, once they know the things they must know, they can go away and play with Bollinger Bands or CCI, anything. And if it definitely improves their trading, then that's fine. But these are the things that we need to know. So I'm not prejudiced against it, but for me, less is more. I like not having to stress. I like going, okay, I don't need trend lines. It's one less thing I have to worry about. So that's a great question because it's nice to know that. Am I planning to speak about Fibonacci's tonight? If I have time. We've got 22 minutes left. And actually, to be honest, the slide deck that you see here, so I know that many of you are going, wow, this is a lot of stuff we're covering. Tonight was really about covering key concepts and some advanced ideas. It's not about doing a course. We're not doing a course tonight. That's not what we're doing. But I would say to you that if you want to see a trading program that we've developed, you need to email ATFX at the end and ask for it because they don't know what you need until you tell them. And I would be more than happy to put something like that together for you guys. So horizontal support and resistance levels are important. Qualifying the price action is so important. Higher time frames, the monthly, weekly, and daily, that's really where the market is ultimately going. All right. So for beginner traders who haven't been told this, it's not the lower time frames. It's not the 5 minute and the 15-minute that is ultimately determining where the daily is going. It's usually the monthly, weekly, and daily that's going to determine where the market is ultimately going to go. So we need to know, even if I'm going to trade the 15 minutes, I want to know where the weekly and monthly is going. You'd be amazed how monthly and weekly levels can impact the 15-minute trading time frame. Moving averages. So I was talking to you about how they frame price action. Let's talk, I'm just going to repeat that again. So let me just go back to the charts and then I'll come back to this. Okay, so if we go back to this chart and have a look at it, the moving averages, the 50, 20, and 10, for example, we can use the 200 as well. But these three are very powerful because when it's trending beautifully, it gives me, it helps me identify, it frames price action. It tells me where I should be looking to get in when price comes back to the moving averages. And if it's left the moving averages, I should just let it go. It's too late to get in. The second thing that it does is the red, the 50 and the 20 and the 10 represent the medium term and the shorter term averages of price. So sometimes the price action, the candlesticks are so volatile, I can't see what's going on. I don't know what's going on. But if I look at the moving averages, they tell me that the averages of price are going up or down or nowhere. Right now, if you look at price action, the 50, 20, and 10 all going sideways. So even if I ignore the candlesticks, take them away, I can see that actually price isn't going anywhere. So they tell me also, they give me clues to where my entries can be. So those are optimal entries. They're safer entries because generally from here, price will head away and go into profit. And they frame price action. They help tell me their prices. When price is too far away from the moving averages, it's overextended. So they give me a frame of reference. Very powerful if we look at them in the right way. It's about understanding what it is that they're doing and what they're telling us. So next on the list of items is trade and risk management. Okay, so when we talk about trade and risk management, I want to spend a couple of minutes on this before I go to the next slide. Trade and risk management. Okay, there's a lot of important stuff about that. Risk management, we usually talk about traditionally risking 1% per trade. It doesn't seem like much, but for those of you who are wondering, at Trade with Precision, we reasonably expect to do somewhere between 2 to 5 trades per week, with ideally about a net profit out of those 2 to 5 trades of 1% net profit per week. If that compounds, we get about 5% per month. That's reasonable to expect that. That's not being unreasonable. That gives us a frame of reference again of how many trades we should expect to see. It might be from a single chart. There might be one instrument that's trending like crazy and we just keep getting in and taking profit, but we have to take profit. All right, our stop loss is there purely to protect our existing capital. That's why it is in this universe, is to protect. It's like a bulletproof vest or a parachute. It's there to protect our existing capital. We cannot grow our accounts without taking profit. So taking profit is as important as having a stop loss. Stop loss is there to protect what we have. Taking profit orders is there to add to what we have. And so generally, we are looking, these strategies that we look at, or generally trades in trending markets, it's reasonable to expect the market to do about a 3-to-1 reward to risk. Maybe in currency markets that aren't always trending that much, maybe 1.5-to-1. So that means if I look at a candle, so let's say I'm looking at an entry over here. So I'll zoom in. Okay, zoom in, and let's say that prices come back to the moving averages, and I'm looking at a potential entry into this trend. So excuse me, I look, let's just see if there was another entry here. So I'm just going to zoom out a little bit, see if there's a better one. Okay, so let's say that I look at one of these bullish candles in the buy zone as a potential entry. Usually what I would look to do, okay, zoom in. Adam, there we go. Sorry, oops, I didn't want to do that. That's coming later. So usually with my personal favorite strategy, I'm going to use the candle here as actually the turning point. Price comes back in and price turns around and heads out. So I'm going to be using a particular candle as my entry. And usually I'm going to be looking to get in above the high of that candle on the 4-hourly or the daily, maybe a pip plus the spread above the high. So let's say the spread is 2. And there are little spread indicators you can find, but let's say the spread is 2. I'm going to add 2 above the high of that and put my stop loss 2 pips below the low of that. That will be my entry and my stop loss. And that represents my 1% risk, right? That's my 1% risk. So therefore, my 1% target is going to be approximately here, 1% target, 2-to-1, 3-to-1. Most importantly for me, and this is about risk management, having a stop loss, and trade management, taking profit off the table. So for me personally, I'm always closing half my profit out when I get to 1-to-1. When I do that, I can leave my stop loss where it is, but I always take half my profit off the table at 1-to-1, because now my trade has become, at worst, a break-even trade. Worst case scenario, it's a break-even trade. Anything beyond that is profit. So this is my personal comfort zone. Everybody will have each to his own. There is, I don't want to say there's an infinite number of ways of adjusting our stop loss and taking profit. There isn't an infinite number of ways, but there are a large number of ways of doing it. We can trail our stop loss behind every second or third bar. We can trail it behind every bar. We can trail it every 20 or 30 pips or whatever. But also the other thing we need to understand is it doesn't make sense to have a set fixed stop loss of 20 pips when we trade something. That doesn't make sense. It's much smarter for us to, you can see this geography on the chart here. It's the lay of the land. By putting our stop loss behind a physical location in the chart, it makes much more sense. All right, and updating my stop loss to the next physical turning point makes sense. But I also want to be taking profit off the table as we go. There are always going to be trades in the market. So this is a place you have to go to from as a beginner. You don't really know what you don't know, to the point where you get experienced enough that you know you're looking at a good trade setup. You know you're looking at a good trend. You know you're looking at a good entry, and you know you need to be taking profits as you go. So this is stuff that hopefully in future webinars with ATFX, we will cover this with you and talk about. So trade management is about updating our stop loss and taking profit off the table, and potentially maybe I've identified this as a very important level. So maybe I've already determined that I have to take all my profits before I get to that level. So that puts it in as a potential 3.5 or 3 or 4 to 1 trade. But I've got to take profit at 1 to 1 and then take the rest off before I get to this level. If there's another entry later on, that's fine. I can always take more trades. But one of the things that kills beginner traders is not having a rule for taking profits. Okay, they don't. And then they're up 4% on one trade, but then they don't take profits. Then it comes back and it stops them out. Then they gave back money they actually lost when they were up 4%. Stuff like that is frustrating. So the general rule of thumb is if we're trading currencies, maybe we look at taking some profit off at 1 to 1 and maybe all our profit off at 1.5 to 1 or 2 to 1. Commodities and indices that trend really well, because currencies is always two currencies pushing and pulling against each other. So ranging is very normal for currencies. Trending isn't as normal. Indices, stock markets, they tend to go up or go down. So they tend to trend really well. Commodities can do both. They can trend really well or go sideways. But 3 to 1 makes sense on an index. So we have got 13 minutes left. So I'm just keeping an eye, but hopefully everything I've said to you so far makes sense. Yeah. So how about below the 20 MA stop loss? Yeah, we can do that. But you know what? You can backtest. If you look at a chart and you find a good trend, you can backtest yourself and go, every trade I see here, what if I put my stop loss here? What if I put my stop loss there? And you can visually find out if it makes sense to do that. That's what backtesting really is. So do we use oscillators to determine entry? No, we use price action. We're focusing on price. It's really easy to do that because that's what we're focusing on. It gives us the most accurate information and it's not that hard. We look for that. We use oscillators such as the MACD or the RSI to help us determine if the trend is still healthy. Okay, this is something we're not covering tonight, but we will cover in future webinars. We can use these indicators and actually not the histogram and definitely not oversold and overbought. That's not reliable enough. It's junk. We can use these to help determine if the trend is nice and healthy. Let me show you what I mean by that very, very quickly because it's not on the slides. You see here how we've got a fresh high in price here. You see how it goes from this high to this higher high to a slightly higher high. This one is just a little bit higher. But you notice here it's going lower. This is a standard RSI indicator. Default, well, I've set it to 9, but it can be default. The problem here is that the moving averages are heading lower here. The moving averages are heading higher up here. Problem with that is this indicator is telling me the market is losing steam. It implies that this market here is going to either go sideways pretty soon in the next 6 to 18 candles, or it's going to change trend and head lower in the next 6 to 18 candles. Okay, so we use these to tell us if the trend is healthy. We don't use them for entries or stop losses. Again, ladies and gentlemen, the best for entries and stop losses is moving averages and horizontal levels for taking profits as well. That's the lay of the land. That's exactly how much room there is on the chart to move and enter. So there's a question here, how about T-bonds? Okay, any market, but it's got to be trending. It has to be trending. That's the point. Next question, as a scalper taking small profits due to small amounts invested, which time frame should I be monitoring? That would generally be the lower time frames, but it might be even up to the 4 hour. It's really about the size of the candle. This little candle here could be something as small as 25 pips. 25 pips, I could trade that on a $500 account if I've got the kind of leverage that I want. So it is also about the candle size. Small candles are very good for us. Big candles are very problematic. We don't want to get into a trade on a very big candle because then our one-to-one distance is very far. This one-to-one distance here is determined by this candle size. If this was a big candle like this, I'd have to go twice as far and it becomes higher risk. Okay, but generally 1 hour, 30 minutes, 15 minutes is good. And again, understanding, we have to accept as traders that the 5-minute chart, the 30-minute chart, the 1 hour chart is much more volatile than the higher time frames. Okay, it is. So it's going to be high risk. So that's something we need to accept. Let's go back to the slides again, ladies and gentlemen, because I need to get to the second one, and we've actually done okay. I feel that I have covered beautifully. I hope you do as well. I know you're panicking because you're beginners and you're thinking, okay, it's a lot of information. Not all of you are, but that was a lot of information. But I feel that we've covered looking at what a trend should look like. Horizontal price and resistance levels, higher time frames, the moving averages, of course, and trade and risk management is important as concepts. These are just concepts. So tonight is not about doing a program, it's about introducing these concepts to you. So when we talk about advanced techniques specially suited to Forex, we want to add to what we currently have. We want to add stuff to it. So let's talk about the things that are quick to talk about. Avoiding volatility, staying away from news announcements. Professional traders do not trade the news. That's another misnomer. What I want is a trend that will continue without any interruption. And the one thing that is guaranteed to mess up a trend, to break it, to destroy it, is news. So I don't want to trade around the news. Trading the news is gambling. We don't know how the market's going to react. We don't know what it's going to do. It's gambling. So we want to avoid volatility in terms of, there's two uses for volatility in trading. Volatility means movement. So we need a market that's moving. So trending markets are volatile, but also volatility in the sense that it's violent, it's choppy, it's unpredictable. We want to stay away from any chart. So that implies no matter what the time frame is we're looking at, if that chart is not trending beautifully, we stay away from it because we're going to lose money on those trades. We're going to. And if we're trading it on purpose, then we're gambling. What I mean by that is, you'd be amazed. We have this thing called the money blueprint, ladies and gentlemen. It's how much money we feel we deserve. And we inherit that from our parents and our friends. If we hang around people who are generally poor and they have a poverty mindset, you should Google this stuff. It's amazing. A poverty mindset, or our parents had it. Parents are always saying, oh, you don't deserve that money, or you shouldn't do that, or all those kinds of things. That actually creates a sense of we shouldn't be making money. And so it will kill our trading. Whereas some people, and especially children of wealthy people, grow up being told, yeah, you can, there's no sky, there's no limit. The sky is the limit to how much you make. And so they grow up and they're not afraid of making money. And that kills people who are learning how to trade. So we need to break that bond. Just be aware of it. Just be aware of it. Read it up. Dollar analysis. The US dollar is the single biggest factor in the world. Okay, the US economy is the biggest, 19 trillion. The next closest one is China at 13 trillion. The UK is at 2.7 trillion. Okay, we're a child compared to the US. Okay, they're massive. When they have a bad day, the whole world feels it. Okay, if they get a cold, the whole world gets sick. We just need to respect that. It's not about them being the best or amazing. It's about the reality of the situation. In currencies, the US dollar, if that really decides to move, it will impact all the other currency. We need to understand that. When it says jump, everybody else says how high. So we need to get a sense of is the euro heading lower because the euro is weak or because the dollar is strong? So the way we determine that is by looking at by looking at that. So we're actually doing okay for time. I think I might be able to cover this. So let me go back to the charts and show you what I'm talking about here. So when we're at the charts and I look at the daily here and I go, let's look at euro dollar. Okay, so euro dollar is generally heading lower. Okay, what is the pound doing? The pound's definitely heading lower. Okay, what's the Australian dollar doing? It's also in a downtrend. What's the Kiwi dollar doing? Also in a downtrend. What do they have in common? They're all heading lower. So what is the likelihood? Is it that by pure coincidence, the euro, the pound, the Aussie dollar, and the Kiwi dollar are all weakening just by themselves? Or is it probably that the US dollar is strengthening and therefore everything else is weakening against the US dollar? Chances are it's the US dollar that's strengthening. So we want to, that's what we talk about correlation. Right now, there's a correlation. All the majors are weakening against the US dollar. That's important. That tells me that if I enter a trade now to the downside, one thing I don't want to do is go against the US dollar. Okay, that's kind of sort of just pairing things. For example, let's look at all, as I said to you, all the GBP charts are heading lower as well. Not all of them, but most of them. So GBP pound, GBP CAD, GBP Aussie, because both of them are weakening, so that's not great. Pound yen is also heading lower. So the pound is also weakening because every GBP chart pretty much that is heading lower. What about the Aussie charts? Aussie is heading, Aussie CAD is going down, Aussie Swissy is heading down, Aussie yen is heading down, and so the Kiwi charts. Believe it or not, ladies and gentlemen, the US dollar is strengthening, which is knocking the euro, the pound, the Aussie, and the Kiwi down. At the same time, and this is rare, the pound is also weakening against its partners, and the Aussie dollar and Kiwi dollars are also weakening. It's really unusual, but right now we've got so many trends. This is unusual. Take note, you will not have this many trends every month this year. What's amazing is that the Aussie, Kiwi, pound currencies are all weakening, and the US dollar is also strengthening. So that's why we've got so many trends, and that's correlation. So if I want to short the Aussie dollar, that's actually high probability of success because all the Aussie charts are trending low. So let me go back to the charts, because the point there that I wanted to show you was understanding these different things. So correlation, okay, dollar analysis, correlation. Silly mistakes to avoid is predominantly about avoiding volatility and not trading the news. Those are really key things. Trading higher timeframes is slightly safer for beginner traders, lower risk of volatility, lower volatility period, trading lower timeframes, and especially around the news, and changing our risk, not trading with stop losses, not taking profit. Those are silly things, because what they do is we get in our own way, and we basically are going to not really help ourselves be successful that way. And so I've been trying to show you more common sense things. Trading should be rational. It should be logical. It should be moving. The market should be trending nicely. We should get in at a sensible place. We must have a stop loss in case for some random reason it changes direction, and we should also take profits. If we get into trending markets, probabilities inherently are that it's going to go in our favor if those are the only markets we ever focus on. So we should always be asking ourselves, is this market clearly moving or not? All right, and by looking at the daily, we can, if it's trending on the daily, it's good. If it's not trending on the daily, it's not going to be making money on the lower time frames, so it's still not worth our while. And the last one I want to talk about here is Fibonacci retracements, and then I'll look at your questions. Okay. So let's go back to this, and then we go back to the chart. So Fibonacci and pivot points are really nice little additional, tools that we can use that help add to the weighting of these horizontal levels. So what we're most interested in when we look at Fibonacci levels is levels that overlap with horizontal levels. So if I go and click on the Fibonacci retracement, and let's just see if I measure it from that high to that high, I'm particularly interested in Fibonacci levels that are very close to, or what we refer to as cluster. They cluster on top of horizontal levels, because some city traders are using Fibonacci levels to place their orders. Other traders are using horizontal levels and round numbers to place their orders. When we start to look at horizontal levels and Fibonacci levels that are close to each other, what we're actually doing is identifying areas where there are more likely to be orders waiting. And please understand that professionals are buying in an uptrend and selling at a downtrend. So if we have an uptrend and we identify price coming back into the moving averages, and it's also coming back to a support level, and it's also coming back to a Fibonacci level, we've identified lots of buy orders in an uptrend. If we were in a downtrend, we would see price coming back to this. So let's say, for example, hypothetically, that price, let's get rid of this Fibonacci thing. Let me go back up to that. I want to show you this quickly, and then we're going to wrap up. So let's go down to this for hourly, and let's say the price did bounce back up here and we were looking to sell, and there was maybe also possibly a Fibonacci retracement to a particular level. If it did, there's a nice little 618 at that level that overlaps with that. In a downtrend, price comes back up to that, and I get a very nice bearish rejection candlestick, a nice little red candlestick that rejects that level. That could be a potential shorting entry to the downside. It's hit a support resistance level, it's in a downtrend, it's coming back, there's a bearish candlestick which tells me sellers are entering the market, and if I put my entry below the low of that candlestick with my stop loss above the high of it, and the market follows through and heads lower, it takes me in with the movement to the downside, and my stop loss has got this additional protection with this horizontal level, which is quite a significant level. I could put my stop loss above the high. If I was very nervous, I could put my stop loss above this high. Okay, so definitely if price goes back up above that, then sod it, the market has gone against me. But if I focus on every trade I take in a trending market, most of the time the market, it's impossible statistically the market's going to go against me every single time. Then I'm doing something else wrong. But if I'm looking in a trending market, trading in the direction of the trend, that's where the money is. That's where the big fish are going. They're pushing it down to the next level. The whales do transactions with each other at these key levels. More money is traded at these price levels because that's where the bigger money is. All right. The reason is that when you're trying to get into a market for 300 million, there isn't always going to be a buyer and seller to get you in and out at any single price, but they usually will cluster at the big levels. Okay. So it's the difference between, I guess, a poker game and a slot machine. The pennies are being done at the slot machines, which is in the middle, and the poker games where the big money is at the key levels, if that makes sense to you. Okay, so Fibonacci, when we use it correctly, can identify a 382 or a 50 or a 618, which is basically a proportionate retracement. It's a healthy pullback, ladies and gentlemen. And I'm especially interested in where those key levels overlap with horizontal levels that I've identified, because the density of orders at those levels is going to be significant. So what I wanted you to get tonight was I am focusing on trending markets. I'm calculating where those key levels are. I'm using the moving averages to locate potential entry opportunities in. And when those moving averages overlap with a horizontal level or a Fibonacci level, I get more excited because then there's more resistance. In a downtrend, it's harder for it to get back up at those points because the professionals are also getting in at those levels. Let me look at your questions and wrap up. We're 2 minutes over. We'll be done in the next minute. Okay. Okay. All right, there's some important questions to answer here, so hopefully you're still with me. So the next question is, so I should never look at the news or economic calendars and only invest in trends? This is a very important question. We do look at the economic calendar to know when news events are likely to disrupt trends so that we're not in the market at that time. So yes, we do want to know when FOMC is. We do want to know when non-farm payroll is. We do want to know when high impact news. So if we're trading the 5 minutes or the below 1 hour timeframes, we need to know where low impact, medium impact, and high impact news events are. We need to know that because that's going to mess us up on the lower timeframes. If we're trading the daily or the 4 hourly, we're probably more interested in medium term and high impact news. And we want to know when that is so that we're not in the market and we can also see how the market reacts to it. So yes, you want to know when it is, but you're not going to trade it. You need to know when it is to know when to avoid it. So that was a brilliant question. Thank you very much. And certainly trading in a trending market for me has turned into the least stressful and the most profitable. And that's all I can say about that. How do I draw fib retracements? They are usually measured from previous highs to swing lows. So I'd measure them in a trend. Unfortunately, we've sort of run out of time, and that wasn't really something I was going to cover tonight, but I just wanted to talk about that. And profiting in short trades is about taking profit again at 1-to-1 or 2-to-1 and 3-to-1 as well. This example is in a downtrend. Obviously, I showed you that one. Yeah, the news is taking cover. There we go. All right, ladies and gentlemen, I believe I've answered all of your questions, and I covered actually a lot more than was really originally intended. I think the first slide was going to be everything that was in the market, and we've covered way more than that. So I'm just going to go back to the contact slide so that you've got the contact information. My recommendation is that you either email them or leave a comment saying that you would like them to develop an education program where we can take you through each of these elements in more time. I mean, imagine a 2-hour program where we talk about this strategy in these markets. And even imagine a program where you got to submit trades you took and get feedback on it, because that's one of the things we really need. So these are my suggestions, but they need to come from you, because I suggest them already, but the clients, which is you guys, are the most important part. Need to hear it back from you. But I do want to say it was an absolute pleasure. I really hope, I know that most of you might have thought there was a lot of information covered in this, but they were just meant to be ideas, and they weren't meant to be in as much detail as I might have discussed them at. So I've basically given you more than was originally meant to be the case. And I hope you enjoyed it. I hope you found it instructive. I want to wish you a fantastic weekend. I look forward to seeing you in future webinars. And if you did enjoy this, also don't feel afraid to email and say, that was a great webinar. Can we get more like that? Because if you do that, then they'll give you more. Okay, so dollar yen, there was one question about dollar yen. Dollar yen that is currently not trending as much. And the reason is actually very interesting. The Japanese trade their own currency, so they're counter trading their currency to offset all of the trade disputes. They're trying to keep it's like trying to keep your interest rates at a certain level to offset, to keep the economy stable. So that's quite interesting. They've been doing that a lot. So they'll change their policies to counter the impacts, the negative impacts from all the trade war stuff that's going on. It's ridiculous. Ladies and gentlemen, it's been a pleasure. I don't want to chew your ears off. We're 6 minutes over, but I want to say it was great. The questions were fantastic, and I hope that everybody has benefited from this. So I'm going to say thank you and good night. I'm going to end the webinar, and I look forward to seeing you in future webinars. So thank you again. Genuinely, it was great fun. Thank you, ladies and gents.